This video is a review of East Japan Railway's fiscal year 2025 full-year financial results, period from April 2024 to March 2025. JR East Japan Railway Company, is one of the major railway companies in Japan. It operates in the eastern part of Japan, mainly covering the north and east side of Honshu, mainland. JR East runs key services like the Shinkansen bullet trains, commuter trains in Tokyo and surrounding areas, and regional rail lines. Highlights of fiscal year 2025 financial results. In fiscal year 2025, JR East achieved growth in both revenue and net profit, with operating revenues increasing by 5.8% to 2,887.5 billion yen and net profit rising by 14.2% to 224.2 billion yen. This marked the fourth consecutive year of revenue growth, mainly driven by increased railway usage and higher sales at Ekinaka station stores. All business segments recorded higher revenue and income. The transportation business benefited from increased passenger revenue. The retail and services segment saw growth due to strong Ekinaka sales. The real estate and hotels segment gained from higher shopping center and hotel sales. Transportation segment recorded operating revenues of 1,945.7 billion yen, representing a 5.1% increase, and operating income of 176 billion yen, up 8.8% from the previous year. Revenue from the Shinkansen increased due to higher passenger usage and the opening of the Hokuriku Shinkansen extension to Tsuruga. Revenue from conventional lines also rose, driven by increased use of both commuter and non-commuter passes, particularly in the Kanto area network. Bus operations saw a year-on-year revenue increase, thanks to higher demand for express bus services. Additionally, revenue from railcar manufacturing grew due to increased sales of railcars to non-JR railway companies. Retail and services segment achieved good results, with operating revenues reaching 393.7 billion yen, a 6.6% increase year-on-year, and operating income rising to 60.5 billion yen, up 15% from the previous year. Retail revenue grew due to higher sales at Ekinaka stores, supported by increased railway usage. Advertising and publishing revenue rose as well, driven by stronger transportation advertising sales. Overseas revenue increased year-on-year, mainly due to the inclusion of Decorum Vending Ltd, a UK-based vending machine operator, into the company's consolidated group. Real estate and hotels segment reported operating revenues of 445.4 billion yen, a 6.5% increase year-on-year, and operating income of 120.3 billion yen, up 9% compared to the previous year. Revenue from real estate ownership and utilization grew due to higher sales at shopping centers and hotels. Although real estate rotation revenue declined because of fewer property sales, profits still increased thanks to favorable differences in the cost of sales depending on the properties sold. Revenue from real estate management also increased, driven by a growth in the number of properties under management. Highlights of FY2026 financial forecast. For fiscal year 2026, JR East aims to achieve record-high consolidated operating revenues of 3,023 billion yen, representing a 4.7% increase year-on-year, and a net profit of 227 billion yen, up 1.2% from the previous year. All business segments are expected to see growth in both revenues and income. In the transportation segment, revenue is projected to increase mainly due to higher non-commuter usage, including more inbound travel and the introduction of green cars on the Chuo Line rapid service. However, income growth is expected to be modest due to rising personnel expenses, inflation, and higher labor costs. In the retail and services segment, both revenues and income are forecast to grow, supported by increased retail sales linked to greater railway usage and higher transportation advertising revenue. In the real estate and hotels segment, despite anticipated upfront costs for the opening of Takanawa Gateway City, JR East expects to boost real estate sales revenue. This, along with steady growth from existing shopping centers, offices, and hotels, will contribute to overall revenue and income growth. In the other segment, both revenue and income are projected to rise, driven by stronger system development contract sales and a decline in energy-related costs compared to the previous year. Key mobility measures. Expansion of railway network. JR East is actively working to expand its railway network, focusing on long-term improvements in accessibility and profitability. A central initiative is the construction of the Haneda Airport Access Line. This new line aims to enhance transportation efficiency and boost future earnings. One major goal is to enable direct access to Haneda Airport from multiple directions by making use of the existing railway infrastructure. This will significantly improve convenience for passengers traveling to and from the airport. A key part of this plan is the East Yamate route, which is scheduled to open in 2031. The total estimated construction cost is about 280 billion yen. Once completed, the travel time from Tokyo Station to Haneda Airport will be reduced to approximately 18 minutes, greatly improving access. It is projected that around 70,000 passengers per day will use this new service, highlighting its importance as a major transportation link. Takanawa Gateway City. Takanawa Gateway City is a large-scale urban redevelopment project in Tokyo, designed to create a futuristic and sustainable city space that supports modern lifestyles and innovation. On March 27, 2025, one of its key buildings, the Link Pillar 1, officially opened. The Link Pillar 1 is expected to host a variety of spaces and functions, contributing to the community and economy of the city. Over time, additional facilities such as commercial complexes, hotels, and more will gradually open. Then, in the spring of 2026, the project will reach a major turning point with the opening of the Link Pillar 2, Mon Takanawa, and Takanawa Gateway City residents. Once the project reaches stabilized operation, it is expected to generate annual revenue of around 57 billion yen. Oimachi Tracks. JR East is also preparing to open a new development in Oimachi, Tokyo, in March 2026, aiming to create a new kind of experience-based value called life value. As part of this development, JR East will introduce the group's first-ever serviced residences, which are a type of housing that includes hotel-like amenities and services for residents. In addition, the project will feature open out-mall commercial facilities, which are outdoor shopping areas designed to promote a more open and engaging shopping experience compared to traditional enclosed malls. This new area, named Oimachi Tracks, is envisioned to serve a key role within the broader, greater Shinagawa area. Oimachi Tracks is projected to generate approximately 13 billion yen in annual revenue once it becomes fully operational. Shareholder returns. JR East aims to maintain a dividend payout ratio of 30% and is targeting a total return ratio of 40% over the medium to long term. While JR East will prioritize using cash for growth investments in the near term, it also plans to steadily increase shareholder returns based on the progress of capital investments and business performance. For the fiscal year ending March 2025, JR East will pay a dividend of 60 yen per share, which represents a dividend payout ratio of 30.3%, an increase of 8 yen compared to the previous forecast. For the following fiscal year, FY2026, the forecasted dividend is 62 yen per share, with a projected dividend payout ratio of 30.9%. Since a significant profit decrease due to COVID-19 pandemic, JR East has continued to increase its dividend amount each time, and the dividend amount level has now returned to the pre-COVID pandemic level. Stock price. This is the Japanese yen-based chart for the last 1 year. The Japanese yen stock price is 3,096 yen as of April 30th, and the US dollar stock price is $10.85 as of March 30th. Current PBR is 1.22, and PER is 15.4. Dividend yield is 2.00%. Compared to the past few years, PBR and PER are higher, which means current stock price is higher. During the COVID-19 pandemic, JR East's stock price dropped significantly. And compared to the past few years, including the affected period, the current stock price appears relatively high in terms of both PBR and PER. However, although stock price has been rising steadily recently, dividend yield is higher than in the past because JR East's dividend amounts have been increasing. Dividend yield is always not that high, but JR East's current stock price is reasonable. Conclusion. In fiscal year 2025, JR East achieved higher revenue and profit, and while significant growth is not expected, a slight increase in profit is also projected for fiscal year 2026. Since JR East's main sources of income are its railway operations and real estate projects in prime locations within Tokyo, it has a stable and sustainable business model. Additionally, JR East is actively investing in new projects such as the direct railway line to the airport, as well as large-scale real estate developments like Takanawa Gateway City and Oimachi tracks. These projects are expected to generate new revenue streams once completed. Real estate prices within Tokyo's 23 wards continue to rise, so the value of JR East's property holdings is also expected to increase over time. Furthermore, JR East has been steadily raising its dividend every year, and an increase is also planned for fiscal year 2026. Although JR East experienced a sharp decline in profit during the COVID-19 pandemic, due to the rise of remote work and reduced ridership, it has been recovering since then. Looking ahead, JR East is expected to continue operating a stable and long-term business.